For more on the equity and fixed income markets, we want to bring in Oksana Aronov, who is head of market strategy and alternative fixed income at JPMorgan Asset Management. Oksana, thank you for being here.
Thank you.
You've got a very interesting view of the equity markets and fixed income and watching both of them at the same time. I think the Fed lands front and center on what is determining so much of this right now. What do you see happening in the fixed income markets? What do you see happening with stock market as we hear from the Fed that, look, rate cuts are likely, we just don't know exactly when?
Yeah. It's really interesting because as a credit watcher and someone who focuses on the macro a lot as a credit investor, certainly when you look at equities through the prism of the rate cuts that they're likely pricing in, as well as many other metrics, they definitely seem to be running quite frothy. And in fact, I think the Fed is really allowing this by essentially letting the market and the economy live in a 3% inflation world, higher than that, really, while talking about getting to target and talking about rates. But really, if I'm Jerome Powell, what is the impetus for me to do anything right now, right? The economy is doing fine. Unemployment is below even what the Fed considers to be neutral. The inflation rate is above even in their longer term projections, their target. And the economy does not seem to be restricted by these rates, in spite of what he said in the press conference, which was kind of perplexing. The reality is that the economy continues to track strongly. In fact, it was really interesting because the projections of the Fed for 2024 in terms of growth and inflation have gone up, but they're still anticipating 3 cuts. The projections for 25 and 26 in terms of growth and inflation are unchanged, but they're expecting less cuts. At least that's kind of their official guidance. And I think that's really interesting and fascinating. I think in reality...
You think it's not real? You think those cuts are going to go away?
I just don't see the impetus for him to do anything. You know, we were here maybe 6 months ago. I was talking to you and I said, look, in the absence of anything breaking down, the Fed is not doing anything. And that was when January cuts were priced in, March cuts were priced in, September cuts were priced in. I said, look, there's nothing going to happen. There's nothing wrong right now with clipping a very healthy coupon at the front end of the curve while also looking for opportunities, which do exist, and we are taking advantage of them because you can absolutely earn more than cash. You don't have to sit in cash. But in the absence of anything breaking down, it's really hard to see why they would do anything here.
Okay, if the market has already priced these rate cuts in and the Fed does nothing, does it create a problem? Or is it just kind of weaning the markets off of this idea and letting them get to the point where they realize, okay, the economy's in great shape, so we don't need to cut, and that's the best case scenario?
I think it creates a problem for fixed income investors, perhaps less for equity investors, because I do think we've also seen the focus come away a little bit from the rate cuts, although they are certainly part of the conversation in equities, and more towards earnings. And earnings have been strong and they have been constructive, and that is the tailwind for equities. I think for fixed income investors, the passage of time will continue to spell disappointment because our 10-year is still very much priced for a 2% inflation world. If you think of the 10-year as growth plus inflation, it is not reflecting where growth and inflation is today, as well as where the Fed is guiding it will be. And in fact, the Fed's kind of this, neutral rate they throw out 2.6%. It's really hard for me to see how or why they've landed on this number, because even from a longer term secular standpoint, if you look, I would say if we pick up our eyes and look over the horizon, right, and you were talking about this earlier, we have a demographic crisis. We have an aging crisis. We have a lot more defense spending. We have a lot more spending on the energy transition. We have deglobalization. Which one of these things is ultimately disinflationary? It's really hard to see.
Although a lot of those things are dependent on lower interest rates to be able to finance.
They are. And so I think what we're going to see is more fiscal spending. And perhaps that is what's guiding Powell to kind of be throwing out these ideas around, rates being lower. But I will say that even though the absolute amount of government debt and the fiscal deficits are tremendous, more than we've ever had, in terms of net interest expense as percent of GDP, we're still below about half a percentage point below where we peaked in the early 90s or before that during the last inflation in the early 80s. And I don't know if that 3.25% expenses percent of GDP is a red line or not, but we're not there yet. So there's definitely more room to run, and the fiscal impulse to spend will continue.